So, Brian, thanks for joining us this morning. Budget 2024 is an expansionary budget and is also projected to end the fiscal year with a small overall surplus of 0.1% of GDP. And this is the first planned surplus in 7 years and compares very favorably with last year's budget deficit of 0.5%. Brian, in your recent report, you wrote about the investment tilt of this budget. Can you take us through your key observations about Singapore's priorities in staying competitive, as well as in attracting quality FDI? Brian?
Hi, Singel. Hey, thanks for having me. Yeah, so I think the idea is the big picture for what Singapore is trying to achieve is that Singapore wants to double down on pursuing economic growth in a more complex and volatile external environment. And this is through, focusing on productivity and innovation to push Singapore's growth to an average of about 2 to 3% each year over the next decade. So I think a crucial strategy for growth is to attract high quality and high value investments from overseas into Singapore, given the small size of our domestic market. So, high quality, high value FDI will bring the latest know-how and create good jobs for Singaporeans. So I think in that vein, there was more support rolled out in this budget to tap on national competitive advantages. Like for instance, the Financial Sector Development Fund will be topped up by $2 billion to provide MES with more resources to extend Singapore's lead in core areas of financial services and also develop emerging fields like fintech, green and transition finance. And also there's more support for R&D. An additional $3 billion was injected into the Research, Innovation and Enterprise 2025 plan to sustain R&D investments at about 1% of GDP, plus AI development as well, another frontier emerging field. More than $1 billion will be invested over the next 5 years, and also additional resources will be put towards upgrading the nationwide broadband network to enable 10 times faster internet speeds of up to 10 Gbps to enable this, new technologies such as AI and facilitate the use of this technology. I think there were also some measures to aid the green transitions, given that Singapore is aiming to achieve net zero emissions by 2050. An initial $5 billion will be injected into a new future energy fund, and this will be used to help build critical infrastructure needed for the nationwide energy transition, such as submarine cables for electricity import, grid upgrades, and energy generation and storage facilities. And I think on the FDI incentives front, the investment promotion toolkit was enhanced in the face of intensifying competition for investments from other countries. You have advanced developed countries like the US, Japan. They are throwing billions of dollars at trying to attract FDI to their shores, especially on semiconductors. And also, BEPS 2.0, Singapore will be implementing a global minimum tax of 15% starting next year. So I think in that vein, the National Productivity Fund actually received an additional top-up of $2 billion. And this is not the first time it was topped up. It was topped up by $4 billion in last year's budget. So I think specifically the most notable measure, a new refundable investment credit, was actually introduced in order to help subsidize, expenditure on high value activities, including setting up or expansion of manufacturing facilities, R&D, and so on and so forth. And I think this marks a change in Singapore's industrial strategy to a more active one. I think in addition, not just MNCs, but Singapore is also doing something to enable technology transfer and more productivity spillovers from FDI into our local firms. So the Partnerships for Capability Transformation, or PAC scheme, will be enhanced to provide financial support for partnerships between MNCs and small and medium enterprises in more areas. Namely, capability training, internationalization, and also corporate venturing. This will basically help more local firms plug into global supply chains.
Okay, that's great stuff. I'm sure all of these will have a lot of implications on the corporate sectors that we follow. But before we kind of deep dive into the stock beneficiaries, can you also help us understand, Brian, on addressing the cost escalation pressures and wealth gaps? for households. What are the key takeaways on consumer consumption, and were there any surprises to you?
Yeah, so I think there were more measures to help address the rising cost of living. The assurance package was enhanced by a substantial $1.9 billion to help defray the GST hike. And this increases the size of the package to hefty $12 billion. I think some measures include, like household grocery vouchers, your CDC vouchers, additional $600, cost of living cash payment between $200 to $400, depending on your income. Also, utility bill rebates and service and conservancy charges rebates. And I think the support was more focused on providing greater benefits to lower income households and also those living in smaller HDB flats. And I think other budget goodies to defray rising costs include, a modest personal income tax rebate of up to $200, Medisave top-ups, and also $200 life SG credits for national servicemen to basically spend on things that like groceries, food, and all that. And yeah, but then I think beyond the short-term relief measures, there was also a focus on plugging wealth gaps. So, for instance, I think some of these measures have already been announced in last year's Forward SG exercise. Like for instance, for lower income families, the COMM Plus progress packages will be rolled out to provide conditional transfers for these families with young children to take action to improve preschool education, also stay in stable employment and also save up for home ownership. And on the retirement front, there's also a slew of initiatives to help seniors with retirement needs, especially those who may not have earned that much in their lifetime and do not have enough CPF savings. So I think this includes CPF top-ups through the $8.2 billion Majula package for Singaporeans born 1973 or earlier. And I think I think was good. I think and a bit of a surprise for us also on the property side. At least it's good that they are introducing more measures to help defray the impact of the property tax hike. So, for instance, the AV bands, annual value bands of all owner-occupied properties will be raised with effect from 2025. And this, in effect, will help to reduce the property tax bill for most homeowners after they were hit by a double whammy of not just property tax rate hikes in 2024, but also climbing annual values with the sharp run-up in market rents. And in addition, it was very encouraging to see that there will be a open market voucher to under the parental provisional housing scheme to support eligible families who want to rent a HDB flat in the open market. And this will basically help support more young families with urgent housing needs while they wait for the completion of their BTO flats. Because right now HDB's rental flat supply is kind of a bit low, and they're still trying to ramp up flat supply to meet the surging demand. Yeah.
Okay, great. Thanks, Brian. I'm going to stop it here on the macro side. And with all of the policy measures that you've just gone over, I think I'm going to try distill down to the sectors that we focus more on and where we have buy calls on our coverage list. So starting with that, I'm going to invite Krishna into our call. Krishna is basically our REITs analyst. Krishna, looking at the raft of top-ups aimed at the household sector investments in Budget 2024, there are clear beneficiaries for the commercial and industrial REITs at that front. First, can you tell us how the sector performed year to date compared to the strong run-up in the REIT sector in fourth quarter of 2023?
Thank you, Singyo, and thank you for having me. So you're right. I think we had a bit of a Santa rally late last year, and also that came after the Fed guided towards the rate cuts. But suffice to say, I think the sector has given up some of the gains that came from late last year. The index itself is down about 5% year to date, whereas your broader STI index is flat. So it has a bit of a slow start, but I think that was expected given the gains that the sector had in fourth quarter last year.
Okay, all right. Well, let's break down into the stocks that you like the most. And we'll start off first with Fraser CENTRPOINT Trust. FCTSP is the stock code. Now, malls for FCT malls are basically running near full occupancy at the moment. What is the upside from here?
So, I think Brian did allude to various measures that government has put forth in the current budget for lowering the cost pressures that households are facing, as well as the reducing the wealth gap. So all that means that is more money in the wallet of consumers, despite relatively challenging macro condition. And with FCT, which is having primarily the suburban malls in good location, the support for the consumption should augur well for FCT. So I think that stock plus the other names such as CICT, which have these the exposure to the local malls here, are definitely the beneficiaries of such move.
Okay, all right. Let's look at CAPITALAND ASCENDAS REIT. The stock was, I think, recently downgraded to a hold because of high borrowing costs. How will the budget's emphasis on R&D and investments related to the national AI strategy impact your longer-term outlook for this REIT?
Yeah, you're right. I think this name plus other one, the Maple Tree Industrial Trust, I will say that investors have to look at a bit more from a medium-term impact. So there is clearly a shift for, there is what we have called the investment tilt in this budget to get more of the value-added FDIs and the higher quality FDIs into Singapore. And then I think the areas that have been chosen for those investments are AI, for example, and then the R&D and advanced manufacturing. So those segments are where the CAPITALAND ASCENDAS and Maple Tree Industrial Trust do have exposure to the high-tech spaces, business parks, and data centers. So they will be the beneficiaries as these investments are rolled into Singapore, and the local ecosystem kind of benefits from those investments. A bit more of a medium term, I think, again, both CAPITALAND ASCENDAS and Maple Tree had a decent run over the last, in the fourth quarter, and some of the gains have been given up. So one needs to take a bit more of a medium-term view, but they will definitely be benefiting from such trend and their own efforts on reuniting their portfolio itself.
Super. Let's talk a little bit about property. Now, property sales obviously has come off quite a fair bit last year. When you look at this sector, what would be a fair valuation range from maybe a price to book perspective when we assess developer stocks? Maybe that will help put things in context for our investors.
Yeah. So I think it's always close to everyone's heart and pocket, I guess. But this is a sticky sector, and it has been going through a slow patch as the cumulative rate hikes kind of take its toll. But what I will add is a couple of things. One is obviously the valuation of the stocks itself, and another point is to consider the business profile of these developers. So I'll start with the second point first. First is for the developers, the large developers, they have a very diversified business profile. So even though you look at the Singapore residential component of these counters, it's probably 20%, 25% of the revenue mix, and slightly lesser on the NAV side of things. So even though there is this slow phase in the sector, they should be able to overall maintain their earnings and their book values, even though they kind of go through this particular phase. And the second point is on the valuation, which you rightly pointed out. I mean, some of these counters are trading at 40 to 50% discount to their book value, and in some cases the books are not yet revalued. So that gives some of the valuation comfort as well. Yes, some of the older investors will point out that these are value traps, but in these sectors, the valuation is always the comfort, and then some catalyst comes always in terms of the growth outlook. So that is where I will kind of put it. In the budget, there has been some supportive measures, even though I will not say that this has been extremely generous for the developers as well. Some of the clawback rates for the developers, additional buyer stamp duty that they have to pay on the land cost itself if they don't sell the units by the stipulated 5-year timeline, that has been lowered. But still, I think the government has maintained the pressure on these developers to be disciplined about their capital allocation and be nifty on on the execution and pricing. So I think the pressure is still there, but definitely the government has kind of taken the pressures that they are facing through in consideration as well.
Great stuff. PROPNEX is a proxy to this sector. And looking at what the government has put in place to help senior single Singaporeans to basically own a second property or to downgrade to the second property. This stock clearly looks like it's undervalued at this moment. Would you help us basically comment on its fundamentals as well as its balance sheet, Krishna?
So I think it's so just like any agency business, it is an asset-light business. So you do have the benefit of not being impacted by the higher interest rate environment. And back to what government has done in terms of making it easier for singles and decoupled seniors to kind of right size into another property. And saving on the ABA, the additional buyer stamp duty, that in our view should encourage such individuals to kind of take benefit of the market and right size. Therefore, it will have higher volumes, which in turn will be beneficial for names like PROPNEX. Yes, we are, as I said, that we are seeing a slow phase both in terms of the primary sales and secondary transactions as well. But such moves, I think, will help such individuals to be a bit more considerate about the pricing and kind of bridge that buyer-seller gap that is currently prevalent. So PROPNEX definitely is benefited from this move. Plus, they do have a dividend policy as well to pay out 80% of their payout. So definitely that helps the stock. I think, if I'm not mistaken, on the valuation side also, they are probably in high single-digit earnings multiple, which is also not too demanding.
Okay, thank you. I'm going to go into the technology sector right now. There are certainly lots riding for Singapore as it aims to deepen its competencies through the national AI strategy. There's an additional 1 billion that will be invested over the next 5 years. This also includes access to advanced chips and setting up AI centers of excellence. I have Jarek on the call. Jarek's basically our tech analyst. Jarek, let me first start on CSE Global. Can you first comment on its order book outlook in the context of budget 2024, please? Jarek?
Sure. I think for its order book, I mean, in the budget of 2024, I think if you look at the budget, they're going to build this cyber security center in Punggol. I think that, CSE, because they are a system integrator and they are the official vendor list for the government, they have been doing a lot of stuff like this for the government since, back 10, 15 years ago. Right? So we think that there's a good chance that they could actually tender to win for some projects on this Punggol Security Center. In terms of contract size, we don't know yet because the tender is not out yet. So, but we estimate, easily to be between about maybe 30 to $80 million worth of contracts and potentially more in terms of maintenance. Yeah, but that will be for the forward for the future. And then also, if you look at basically what, like all the AI centers and all, I think that, with more of this also, CSE could also potentially win some contracts from that side as well.
Okay, great. Well, you also like UMS, and the company recently clinched a new customer whom you believe to be NASDAQ listed LAM Research. What is the impact here?
Okay, so I think that UMS has traditionally been only a one customer company, which is Applied Materials for the longest of time. And I think recently things got interesting for them because they actually got a new customer, which we believe to be LAM Research. And they have actually built 2 plants, or rather 2 buildings in Penang for this new customer. So if you look at the capex they put in about close to $30 to $50 million worth of capex, and this customer is looking to grow with them longer term. So if you look at it in a way, management guided that in 3 to 5 years, the revenue contribution should be around $300 to $500 million worth from this customer alone. So in theory speaking, UMS could actually double its size, assuming that Applied Materials contribution is still the same in terms of revenue base, then UMS could double in size in terms of revenue and even profit base with this new customer in the next 3 to 5 years.
Okay, great. The third and second last stock that you like is AZTECH Global. This company has a new plant in Pasir Gudang. How long will it be for this new plant to achieve full production ramp? And do we assume that the margins will basically stay stable for 2024?
Yes, I think for 2024, the margin should stay stable. In terms of reaching full production, I think that it will probably take another 6 months to 9 months more before they can before they can reach full production because of the customer schedule and also because they are shifting some production from China to the Pasir Gudang plant as well. So this will take probably about another 6 to 9 months more before they can reach around about 80% plus utilization.
Okay, great. And last but not least, you also like venture, and you see this as a safe haven holding within the tech sector. Why?
Yes, okay. I mean, you traditionally look at venture. I mean, they have been giving good dividends even in good times and bad times because the company has a lot of cash. I think their balance sheet, if you look at it, they are net cash of about 500 million. Actually, or more than that. Actually, I can't remember the exact amount, but yeah, 300 million net cash. So if you look at dividend wise, it's quite well supported. The yield is close to about 6%, and in bad times, they will still stick to you giving that the yield that the dividend that they give you last year. So I think if I'm not wrong, interim they give you 25 cents. Final they give you 50 cents, so 75 cents total for the full year. So as an investor, you are actually your downside is actually guarded by the 75 cents. Even if they reported bad results, the dividend should be likely maintained because they can actually sustain it with their balance sheet. And if you look at earnings wise, last year was a bad year for a lot of manufacturers, especially the semicon players, but even for venture. So we do think that this year with global demand recovering and a lot of customers' inventory levels are coming down slowly, this year's numbers should be better than last year. And if you look at the venture chart as well, I think you look, share price is, more lower to the bottom than near to the highs. So we do think that, venture is quite a safe haven, given the upside downside risk is quite muted.
Okay, super. Thanks very much for that sharing.
Welcome.
I'm just going to close the today's show with just one more mention of DBS. Now, Budget 2024 has 4 main drivers that will likely add support to the banking sector. One, of course, as we've just heard from all the speakers, is that national AI strategies should encourage development of AI-enabled revenue streams. 2, the refundable tax credit scheme to support R&D. This will likely help, spur setting up of manufacturing capabilities here in Singapore, which should basically help with banks' loans growth. Third is that the Future Energy Fund should also help spur demand for green loans, as well as debt securities for related infra projects. And last but not least, the budget policies are aimed at reducing costs plus these cash handouts should also lower the asset quality risk for banks. So within the 3 banks, we basically like DBS for its strong track record of improving shareholder returns and total income outlook has, in our view, upside potential for the reasons above. So with that, thank you very much for joining us this afternoon. Have a great day and week ahead. Happy hunting.